Good morning, good afternoon, everyone. This is Rob Barnett, and I'd like to welcome you to today's VIA Energy Exchange, where we talk about our research and the latest developments in energy markets. Today, we've got a North America focus, so we've got Fernando Valle joining from 731 Lexington, and we've got Vince Piazza joining from Wilmington. And I think we will kick off with the big news in the market this past week. It's only recent memory that we had a very similar discussion on Exxon Pioneer, and now we've got Chevron and Hess with a deal that's been announced. And Fernando covers Chevron, Vince covers Hess. So let's have a good, fun discussion about what it might all mean. Fernando, I'm going to come to you first. What do you make of the acquisition, and do you think it is? How do you interpret it for the future of Chevron?
I think it was a bit of a chess move. It very interestingly, it shows a lot of alignment between Exxon and Chevron. If you look at these two deals, they're essentially mirroring each other's portfolio. Exxon didn't really have a great presence in the Midland, so they bought the best asset on the Midland, which is Pioneer. And while Chevron has had a very large Permian for a really long time, one of their cornerstone assets. Meanwhile, Chevron has really stepped back from deep water after Tengiz, the expansion that's supposed to be completed next year. Really, all they had to focus was shale, and especially the Permian. They didn't have much outside of the Permian, the DJ Basin, and the Montney. Maybe Vaca Muerta if you really want to push it. So they went out and bought Hess, which is a minority partner in Exxon's Guyana project, which is probably one of the top 5 assets in global oil today. And on top of that, they got a little bit more Gulf of Mexico and in the Bakken, and now they have a similar position in the Bakken as Exxon as well. Probably a little bit better, to be perfectly frank. But when you look at it now, Exxon and Chevron have very similar footprints, very similar growth profiles over the next decade, and it's really a question of their legacy assets and who is going to execute better over the next coming decade. And we can have a discussion there. I think ultimately the differentiator between the two is really down to one asset, which is Qatar Gas, Exxon's best asset and probably the best upstream asset in the world. They have the most favorable terms. They have the most exposure in that asset. It at times has contributed as much as 15% of Exxon's consolidated EBITDA. So it's really something that we expect to really be very profitable to them over the next decade, barring any geopolitical tensions with Iran.
Okay, very interesting perspective, Fernando. Vince, I want to come over to you, and just for everyone listening, if you didn't see it, we write what are called reacts whenever news like this hits the wire. It's kind of the first version of analysis, emergency room of analysis. Vince, your react was called Chevron-Hess deal, a surprise given lack of overlap. So maybe your thinking has shifted since that react, but give us your sense. What does this mean for Hess, and how do you see it in the sort of E&P space that you look closely after?
Well, Hess was one of the larger companies I covered, and so a bigger guy would have needed to take out Hess, and Chevron obviously stepped on up. But it seemed from conversations with the family and management overall, it seemed that they were very keen to go at it alone for the time being. I think it was a surprise because when I look at my portfolio of companies, I would think that they were the least likely to agree to something like this, given the fact that I have smaller companies, mid-cap and small-cap companies who are in need of more scale, and just given the fundamental outlook, would have a harder time going at it alone. Obviously, Hess while not the operator in Guyana, they have a pretty sizable interest there. So there was an opportunity there to enhance that portfolio. But I think what it really says for folks in my universe, from my coverage universe, is that it's going to be pretty difficult to go it alone. And what we mentioned a couple of weeks ago during our discussion on Pioneer being bought, you're going to have fewer, larger names in key plays. We're talking about the Permian, but you could also make the argument on the gas-levered basins as well, whether it's the Haynesville or the Marcellus. You will likely have fewer, larger names with bigger balance sheets, with more resource potential, and a very hefty life cycle for inventory. And that's still the case, I think.
Okay. Very interesting, Vince. For anyone who didn't see it, there's a really good interview with Alex Steele and Guy Johnson from Bloomberg TV. They sat down with Mike Wirth and John Hess. Good, entertaining watch to get a sort of sense on the deal and the strategy and how it all fits together. And Fernando, I want to sort of come to you with a sort of broader strategy question here. We've noted for a long time this divergence between U.S. and European strategy. We've had two really big deals. Do you think some of the European majors, Shell, BP, on down the line, are they under pressure to also make acquisitions in this environment? In your view, do you think that they're going to be more shy? Are there entities that they might be interested in out there as well?
Yeah, that's a good question. And first, I wanted to come back to Vince's point that it was a surprise because I actually was speaking to Brett, and I said when Pioneer was acquired by Exxon on October 5th, it's like Chevron should go out and buy Hess. So not an entire surprise because it's a good move by them, I think. I think the two premier assets in upstream oil and gas are gone. It's the attainable ones, because if you look, Exxon has 45% of Guyana, and Hess has 30%, and then the next one is CNOOC from a national oil company for China. They're not interested in selling, so you can't really acquire into that block. There are smaller entities, but they have a much larger degree of exploratory risk still. They're not in the development stage like the Stabroek block in Guyana. So you could acquire exploration and appraisal assets, but not really development assets. You could move towards Brazil, but again, most of that is with the super majors already. Shell, Total, BP, less BP, Equinor, some Chevron. So there's very limited small scale players that you could acquire in that region. So I don't see anything today that's sizable and attractive outside of the Permian and outside of the oil sands where BP and Shell could make an impact, and they seem not keen to step into either of those locations. In fact, Total just sold their assets in the oil sands recently to Suncor and ConocoPhillips. I do expect the U.S. mini majors like Vince's Occidental or ConocoPhillips that I cover to make more acquisitions. They both did deals recently, Anadarko for Oxy, Concho and Shell's Permian assets for Conoco. And even as the new Shell CEO said, they hope they'll be very quiet. And BP, it's kind of hard to grasp right now because they're going through their changing leadership after Bern Looney resigned about a month ago. It's going to be interesting to see which direction they go. Clearly, they're going to step back a little bit from their very aggressive renewable power investments, but I wouldn't expect them to go back headfirst into shale.
Vince, I want to get your perspective on the motivation for mergers. and or M&A activity generally, higher interest rates are a sort of general phenomena out there right now. And are the E&Ps that you look after, do they need cash to be able to fuel?
You sort of froze up on me there, but I guess to to touch on the theme of the question, balance sheets for the operators. Yeah, balance sheets for the operators I cover, Rob, are in much better shape at this point in the cycle. The leverage is closer to 1 time or below, and while it is a capital-intensive business, investors have been very clear what they want from the operators, and that is a return of excess cash. So we're not talking about production growth. We're not talking about reserve growth. We are talking about a more disciplined CapEx program, a more disciplined drilling program, more disciplined production growth overall, which would provide a steady state free cash flow generation. So while higher interest rates would preclude smaller operators who don't have as much flexibility, for the mid-capish operators, they're in much better financial shape. So, and because of the valuation differential, some of the mid-cap and larger cap operators that I do cover are trading at, a 2-turn premium to some of the smaller guys. And so that in of itself provides an arbitrage opportunity to leverage your higher valued currency to pick up a smaller player. Even some of the PE-backed operators who are looking to monetize those older vintages, they're looking to have public currency, right? And so a merger with a public entity provides that transparency of value and gives the PE funds an opportunity to exit after a certain period of time. So that's what we're likely going to see a lot more of. You saw it to some degree in the Permian. I think you'll see it some more now. And you'll definitely see smaller corporate on corporate deals. What happens to Permian Resources? What happens to Matador? What happens to even the likes of Civitas and some of the other players as well? Look, scale is the key, and having runway is the key. Having contiguous acreage is the key. And so, again, in a commodity type business, it's having scale and generating efficiencies, controlling the cost side with that scale. And so I think that'll be the key. Interesting. I know we're talking a lot about Permian and a lot about oil, but I would not forget that we have 2 very big gas levered plays, the Haynesville and the Marcellus. And not sure if folks have focused on the rumor most recently about Chesapeake and Southwestern. Those are 2 fairly sizable names in 2 of the most prolific gas levered basins in the U.S. And so a tie-up like that reinforces the view that you have fewer but larger names with greater scale across the platform to have a longer inventory life.
It's going to be very interesting to watch the space, see if any additional M&A unfolds. So look forward to continuing this discussion with you and the rest of the team. Maybe if we switch gears a little bit right now and talk about Fernando's focus idea. Now, for everyone listening, if you don't know what a focus idea is, these generally we'd characterize as our highest conviction out of consensus view that we maybe have on an aspect of the market. And so hopefully if you've seen Fernando's focus idea, you'll sort of recognize that it's there should be an aha moment, something that sort of is different from the way the rest of the market is seeing something. So Fernando, you've got the focus idea out just the other day. It's from October 23rd for anyone who missed it, and it's called Diesel gasoline's $27 gap may spike to record highs, BI Focus. So, Fernando, tell us about your idea and what you're anticipating as we head into winter.
Yeah, thanks, Rob. It's I'm actually running it back from last year, and it worked well last year. And as much as it's a bit of a just rehash, it's actually worse, I think, this year than last year. It's in ways a seasonal play, but it's a seasonal play that's attenuated by the current fundamentals. Essentially, northeast of the U.S. sets a lot of the pricing for the rest of the U.S. because it is an import region. Since we can't import fuels from the Gulf Coast due to the Jones Act, we wind up importing from Europe. The inventory levels for diesel are very, very low, as the same level that they were in 2022. At that year, well, this year in February, we saw the differential between gasoline and diesel crack spreads jump to $40 per barrel on average in February and March. So it's got a significant upside potential from here if it just repeats last year. But I'll remind everyone that last year we had the warmest winter in 60 years in the Northern Hemisphere, and that can create significant challenges for Northeast power generators if it's a even normal winter, let alone a cold winter. We use diesel in the Northeast not just for heating, but for backup for power generation. And another attenuating factor is since last year we are importing even less liquefied natural gas into the Northeast. I know Europe is now full on their inventories, but still there is a difficulty of bringing LNG into Boston Harbor because there are no Jones Act compliant LNG carriers, and that puts a significant strain on power generators when the weather becomes colder and the demand for both power and heat go up at the same time. Another and the last factor I'll remind everyone is that in 2021, at the end of 2021, New York closed the Indian Point nuclear power plant. They have built some natural gas capacity, but as Vince can tell you, there's not enough supply coming into New York State. We aren't building new pipelines into New York State. There's a moratorium on new gas pipelines, and so there is a difficulty in getting both natural gas and power into that part of the country. And lastly, Russia has since also prohibited exports of diesel and other intermediates. So it creates a very dire situation in the Northeast, even if the weather just goes to normal.
Very interesting, Fernando. I recall for years I used to walk past the Kindle cogeneration station right on the river, the harbor there in Boston, and it's a dual-fired unit, so it primarily runs on gas, but sometimes runs on diesel as a backup. And yeah, it's very, very interesting how that part of the world can get constrained, especially when it's cold out. So make sure to go check out Fernando's focus idea. It's very interesting, and we'll make sure to highlight some of the additional ones from the team as we look into not just 4Q but ahead to 2024. So I think the topic that we should perhaps close with here today is the IEA put out its latest World Energy Outlook. Whether you agree with the outlook or not, I would say forecasting is hard, and IEA takes a ton of flack for having forecasts that just turned out to be whatever in the past, whether you look at oil or solar, it doesn't really matter. Thinking about the future, I have as someone who does that, I have some sympathy for the exercise that they're involved with. But I'm just going to read the first two lines from the report, and I want to get the two of your perspective on it. So. The first line is, some of the immediate pressures from the global energy crisis have eased, but energy markets, geopolitics, and the global economy are unsettled, and the risk of further disruption is ever present. Then they followed up to say, against this complex backdrop, the emergence of new clean energy economy led by solar PV and electric vehicles provides hope for a way forward. And I would just note that the first figure one of the entire report, basically shows in their key scenario, their stated policy scenario, that oil, gas, coal demand all peak by, I believe, 2030, but all three of them, different years, but before 2030. So this is what the IEA's official narrative on the future of energy looks like. Fernando, we'll come to you first to maybe for a quick comment, and then we'll come over to Vince because I know you got to hop in just a couple minutes, Vince. So Fernando, to you first.
I'll go quickly. I think famous last words, all of those, but the average APR on a car sale in the U.S. is nearing 10% per annum. I don't see how you're going to sell a lot of $40,000 EVs with those interest rates, or even ICE vehicles for that matter. So the fleet change time is going to be longer. Just in the U.S., never mind emerging markets, which are actually the drivers of growth in oil and gas demand. And then just, the coal phase out that they have is ludicrous. We've never actually seen any kind of decline of that rate for any energy source. I mean, we're still using biomass at actually higher levels than we did when it was the main source of fuel, because obviously populations grow. And I would like to see them convince China to let go of coal at that kind of pace when they're very keen on energy security. So those are just a couple of my gripes with those two first sentences and graphs, but I'll let Vince go.
Cool. Vince, over to you.
If it's not windy, if it's not sunny, and if we don't have enough snowpack melting for hydro, where do we go? The more solar, the more wind, the more hydro capacity we introduce, the more volatility into the system we introduce, the more nat gas will remain an ever-present feedstock in the power stack. And I think this will be consistent throughout. The longer term prospect for natural gas is constructive and very positive. The more we have that discussion about solar and wind and hydro, which is intermittent, the more we're going to need a sustainable, ever-present, prolific source like natural gas, and I'll end it there.
All right, Vince, I know you got to run. Fernando, if you want to stay and chat for like another minute or two, let's do it. I was actually going to follow up with, you mentioned higher interest rates, and in our client chat while we've been here talking, someone shared a story about what's going on the in U.S. real estate. So new home sales have surged to their fastest pace since February of 2022, and obviously interest rates are weighing in there as well. So I'm you brought up the interest rate sensitivity, and I'll just say that in my space, looking at the solar names, the interest rates are hurting. Like on the residential solar side, we are seeing very material slowdown in 3Q based on some pre-release figures that are out there, and likely continued headwind in 4Q, and maybe even extending into 2024. But at least on the home sale side, things look pretty good. And how do you judge what's going on there versus your general view on rates?
Well, I think the two factors. First, the amount of deals that aren't actually closing is also surged to its highest, so it's over 18%. So there's a lot of agreements that then don't qualify for mortgages or have other issues. And then the second part is auto delinquencies also highest in years in September. Credit card delinquency is also getting to their highest. So I think there's new home sales is also a key factor because there's a fair amount of builders giving incentive rates, rate buy downs, and the likes to incentivize home buyers into this deal, which of course just creates a time bomb for later once those buyouts run out. And oh, lo and behold, the Fed didn't cut rates as we expected, so we can't refinance at a 3% mortgage rate like we thought we would, and now we can't really afford the 7.5% that we're actually going to pay. So I would take that with a lot of salt, as much as there is in the ocean probably. And you'll see in the wind sector as well, right? I mean, this is not me making this up, but BP, when they had their whole change up to renewables, they said we're going to target a 7 to 9% return on capital rate in wind, and of course they've also haven't done it very well, so they're not even hitting the low end of that level. And you can get treasuries at 5%. Why would I build a wind farm? Why? That's not a good spread.
It's really complicated. I think you're hinting at particularly some of the difficulties we're seeing in offshore wind space. I don't think onshore is quite as troubled, but a lot of the oil majors, they've focused on offshore, and that's where we're seeing the most difficulties. I would note that despite the offshore difficulties, we're actually seeing some pretty good green shoots on the wind side based on order book growth. Vestas announced 4 gigawatts of order intake in 3Q. Nordex, a smaller player, but they announced about half as much. GE with their renewable energy division had some pretty good figures out there as well. So I think there's all this lag kind of thing happening. I do think offshore wind is going to be very interesting. It's actually going to be pretty curious to see how the offshore in the northeast of the U.S. Gets resolved, because the most simple description of what has occurred there is the entities that are developing some of those projects locked in multi-year contracts that are at prices with the Public Utility Commission that are below their cost basis. So I mean, the projects are essentially uneconomic at the rates they're going to get paid, and so it'll just be interesting to see whether those projects even go forward based on some of those dynamics. So
yeah, and I'll mention that those 6 gigawatts you mentioned will produce less than half than Indian Point produced, because obviously utilization factors are not the same.
absolutely, yeah, no doubt. No doubt that the intermittency of wind and solar is a known factor. I personally believe it's a manageable factor, but I mean, you're naive if it's not part of the calculus of how you run the grid. So anyhow, we will get the band together and talk deeper on some of this stuff. We're doing these weekly now, so for anyone who's listening in, we'll get back together next Wednesday with some of the team. Next time we'll have Will Hares and Sally Ilmaz and Patricio. Fernando, I think you'll join next week too. And so join us up. We'll talk about some of the things we're learning from the 3Q earnings cycle. We'll talk about some of our focus ideas, and we look forward to being in touch. Just shoot us an IB if you got any follow-up questions in the interim. Oh, one last thing. For anyone in New York City, we are planning an in-person event for Wednesday, November 8th. I'm just going to look at a calendar and make sure I'm giving you the right date. Yeah, Wednesday, November 8th. It'll be in the afternoon. Small roundtable discussion like this, followed by a pint if you care for one. So Look for the announcement on that, and we hope to see you there for anyone who's based in New York. Talk to you soon.